You're 38 years old scrolling through Zillow at midnight for the third time this week. Every house you can almost afford feels like it's overpriced, and every open house you visit has 10 other people who look just as desperate as you feel. Your parents keep asking when you're going to stop throwing money away on rent. Your friends who bought in 2019 won't stop talking about their equity gains. And meanwhile, mortgage rates are sitting at 6%, home prices haven't crashed like everyone predicted, and you're wondering if you're about to make the biggest financial mistake of your life or miss your last chance at home ownership forever. My name is Richard, and I spend way too much time studying financial literacy, the economy, and why some people build million-dollar net worths while others stay trapped in financial quicksand their entire lives. Today, we're diving deep into the question that's keeping millions of people up at night. Should you actually buy a house in 2026? And I can guarantee that some of what I'm about to tell you will completely change how you think about home ownership, real estate as an investment, and what it actually means to be financially stable in your 30s and 40s. Now, before we dive into whether you should buy, let me share something that might surprise you. The median age of a first-time home buyer in America just hit 40 years old. That's not a typo. 40! The oldest it's ever been in recorded history. Meanwhile, only about 1/3 of American households can actually afford to buy a median-priced home right now. In expensive states like California, that number drops to just 15%. And here's the kicker. Mortgage rates in 2026 are expected to hover around 6% to 6.5%, which means even if prices don't skyrocket, your monthly payment is going to feel like it did. And so let's talk about what 2026 is actually going to look like, because I think a lot of people are operating under some assumptions that just aren't based in reality. And those wrong assumptions are going to cost them a lot of money. The first thing you need to understand is that mortgage rates are not going back to 3%. They're just not. I know everyone's waiting for that to happen. I know your real estate agent is probably telling you to buy now and refinance later when rates drop. But the experts, the people who actually study this stuff for a living, they're saying rates will probably ease down to somewhere between 5.9% and 6.5% throughout 2026. That's better than where we've been, sure, but it's still historically high. Your parents bought houses when rates were in the single digits and thought that was expensive. You're looking at rates that are double or triple what they were just a few years ago. And here's what that means in real terms. Let's say you're buying a $400,000 house, which in most decent-sized cities is pretty modest, at a 6% interest rate with a 20% down payment. Your monthly payment just for principal and interest is going to be around $1,900. But that's not the full story. You've also got property taxes, which depending on where you live could be another $400 to $600 a month. Then there's homeowners insurance, which has been going up like crazy. That's another $200 to $300. And if you're in an HOA, tack on another $100 to $300. So your total monthly cost is probably going to be somewhere between $2,500 and $3,200. And we haven't even talked about maintenance yet, which is usually about 1% to 2% of the home's value per year. So that's another $4,000 to $8,000 annually that you need to be ready for. Broken appliances, roof repairs, plumbing issues, stuff that just comes with owning a physical structure that's slowly falling apart. Now, the second thing people keep waiting for is a crash. Everyone's expecting 2008 all over again. Prices are going to collapse, and if you just wait long enough, houses will be cheap again. But here's what the data is actually showing. Most experts are predicting home prices will grow modestly in 2026, somewhere in the range of 1% to 4% nationally. Not a boom, not a crash, just slow, steady growth. And I know that's not what people want to hear, because if you're waiting for prices to drop by 20% or 30%, you might be waiting forever. The 2008 crash happened because of very specific conditions. Banks were giving out subprime mortgages to people who couldn't afford them. There was massive overbuilding, and the entire financial system was built on those bad loans. Today's market is different. Lending standards are tighter. There's actually a shortage of homes in many areas, not an oversupply. So while regional markets might see small dips here and there, a nationwide crash like 2008 just isn't in the cards according to most forecasts. And that brings us to the third reality of 2026. The affordability crisis is structural, not temporary. This isn't just a bad year or two that we're going to get through. The math has fundamentally changed. In many markets, the income required to afford a median priced home is literally double what the median household actually earns. Let that sink in for a second. The typical house costs twice what the typical family can afford. And it's not because people are lazy or bad with money. It's because wages haven't kept up with housing costs. Not even close. You look at the data and you see that first time buyers are older now. They're bringing bigger down payments, and a lot of them are getting help from family or buying with partners or friends just to make the math work. This isn't a blip. This is the new normal. The game has changed, and if you're still playing by the old rules, the ones your parents followed, you're going to lose. Let me paint you a picture. Let's say you're making $75,000 a year, which is above the national median. In 2026, with a 6% mortgage rate, a $400,000 house, which again is pretty modest in most decent sized cities, would cost you about $2,400 a month just for principal and interest. Add in property taxes, insurance, and maintenance, and you're easily at $3,000 to $3,500 a month. That's nearly half your take-home pay before you've bought groceries, paid for gas, or dealt with any kind of emergency. And if you have student loans, a car payment, credit card debt, or if you're trying to save for retirement, that $3,000 housing payment starts to feel impossible. Here's what nobody wants to admit. 2026 won't reward you for being patient, and it won't punish you for being cautious. It's going to be a test of whether you're buying with a plan that can survive bad luck, or buying out of panic because you're afraid of being left behind. So here's where things get interesting. Because after everything I just told you about 2026, the rates that won't drop below 6%, the prices that probably won't crash, the affordability crisis that's basically permanent, you might be thinking, okay, Richard, so nobody should buy a house ever again, right? We're all just doomed to rent forever? Not exactly. See, the mistake most people make is they treat home ownership like it's either always good or always bad. Like there's some universal answer that applies to everyone. But that's not how money works. That's not how life works. And in 2026, with everything we just talked about, the question isn't, should I buy a house? The real question is, does buying a house make sense for my specific situation right now? And that's a completely different question. Here's why this matters so much, because if you buy a house when you shouldn't, when the math doesn't actually work for your life, you don't just lose a little bit of money. You don't just make a small mistake you can fix later. You trap yourself. You lock yourself into a 30-year financial decision that will determine where you can work, how much stress you carry every single day, whether you can save for retirement, whether you can switch careers if you hate your job, whether you can help your kids with college, whether you can ever actually relax about money. I'm not exaggerating. A bad house purchase in 2026 could be the single decision that keeps you financially stuck for the next decade or more. Because unlike a bad car purchase, where you're stuck for maybe 5 years, or a bad vacation where you waste a few $1,000s, a house is different. A house comes with a mortgage that follows you around like a shadow, property taxes that go up every year, maintenance costs that appear out of nowhere. And if you bought at your absolute limit, if you stretched every dollar just to qualify, you're now living in a prison that looks like the American dream from the outside, but feels like suffocation on the inside. That's what's at stake here. But, and this is important, if you buy at the right time, in the right way, for the right reasons, a house can actually work for you. Not because real estate always goes up, not because it's some magical wealth building tool, but because it forces you to save money you otherwise wouldn't save. It locks in a big chunk of your living costs, so inflation can't touch it, and it gives you stability in a world that feels more unstable every single year. So let's talk about when buying actually makes sense. There are 3 things that need to be true before you should even consider buying a house in 2026. Not 1, not 2, all 3. And if even one of these isn't true for you, you need to wait. I don't care how much pressure your family is putting on you. I don't care how tired you are of renting. I don't care if your friends just bought and they're posting pictures of their backyard on Instagram. If these 3 things aren't true, You're not ready. Here's the first one. You need to be planning to stay in that house for at least 7 to 10 years, minimum. And I know that sounds like a long time, especially if you're in your 30s or 40s and your life still feels like it's in flux. But here's why this matters so much. Every time you buy or sell a house, you lose money. Not a little bit, a lot. When you buy, you pay closing costs, usually about 2% to 5% of the home's price. That's $8,000 to $20,000 on a $400,000 house just to sign the paperwork. Then when you sell, you pay a real estate agent commission, usually about 5% to 6%, which is another $20,000 to $24,000. So right there, you're down $30,000 to $40,000 just from buying and selling before you've even lived in the house. Now add in all the little things, moving costs, repairs you have to make to get the house ready to sell. Maybe you have to replace the carpet or repaint because the buyer's inspector found something. Maybe you have to drop your price because the market shifted. All of that adds up. So here's what people don't realize. In the first few years of owning a home, you're not really building wealth. You're just recovering from the cost of buying it. Your mortgage payments in those early years are mostly going to interest, not principal. So you're not building equity fast. And if you have to sell before you've been there 7 or 10 years, there's a very real chance you'll walk away with less money than you started with, even if home prices went up a little bit. So how do you know if you're actually going to stay 7 to 10 years? You have to be honest with yourself about your life. Are you in a relationship that's stable, or are you still figuring things out? Is your job something you can see yourself doing for the next decade, or are you thinking about a career change? Do you like the city you're in, or are you only there because of one specific thing that might not last? I'm not saying you need to have your entire life figured out because nobody does. But if there's a decent chance you'll need to move in 3 or 4 years, buying a house in 2026 is a gamble. And it's a gamble where the house always has the advantage. Think about it like this. Buying a house is like getting a tattoo on your face. I'm serious. Once you do it, it's really hard to undo. You can do it. People get tattoo removal. People sell houses, but it's expensive. It's painful. And you're going to lose something in the process. So before you commit, you better be sure. You better be really, really sure. Renting is more like trying on clothes. If it doesn't fit, if you don't like it, if your life changes, you just give it back and move on. There's no penalty, no huge loss. You're free. And in 2026, with everything being so expensive and so uncertain, freedom is worth a lot more than people think. All right, here's the second thing. Your house payment needs to be comfortable at today's mortgage rates. Not the rates you hope will happen. Not the rates your lender is telling you might come next year. Today's rates. Right now. And I know this sounds obvious, but you would be shocked how many people are buying houses in 2024 and 2025 with a plan that goes like this. Yeah, the payment's a little tight right now, but once rates drop and we refinance, we'll be fine. That is a disaster waiting to happen. Here's the thing. Nobody knows when rates are going to drop. The experts are saying maybe late 2026, maybe 2027, but they've been wrong before. They were saying rates would drop in 2024. Didn't happen. They said it again for 2025. Still didn't happen the way people hoped. So if you're buying a house and your entire plan depends on refinancing in a year or two, you're not making a financial decision. You're making a bet. And if that bet doesn't work out, you're stuck. And here's the part that really scares me. A lot of people are qualifying for mortgages right now that eat up 40%, 45%, even 50% of their take-home pay. The bank says they can afford it, so they assume it's fine. But the bank doesn't care if you're stressed. The bank doesn't care if you can't save for retirement or if you're living paycheck to paycheck. The bank just cares that you're making the payment every month. So here's the test. Take the monthly payment you'd have at today's rates, the real payment, including property taxes, insurance, HOA fees, if there are any, and a little bit extra for maintenance, and ask yourself this. If one of you lost your job tomorrow, could you still make this payment for 6 months? A year? If the answer is no, you're buying too much house. Period. I don't care if the bank approved you for it. I don't care if it's the only house in your area you can afford. If losing one income would mean you'd have to sell the house or go into foreclosure, you can't afford it. Not really. Let me tell you about someone I know. We'll call her Sarah. Sarah and her husband bought a house in 2021. They got a great rate, like 3.2% or something. The payment was manageable. Life was good. Then in 2023, her husband got laid off. Just like that, no warning. Tech industry layoffs. Suddenly they went from two incomes to one. And even though their mortgage payment wasn't that high compared to what people are paying now, it was still more than Sarah could cover on her own. They burned through their savings in 4 months trying to keep up. They put expenses on credit cards. They borrowed money from family. And finally, they had to sell. But here's the thing. Because they'd only owned the house for 2 years, and because the market in their area had cooled off a little, they didn't have enough equity to cover the closing costs and the agent fees. They had to bring money to the closing table just to get out of the house. They walked away with nothing. Less than nothing, actually, because they were now in credit card debt from trying to hang on. That house didn't build wealth for them. It destroyed what little wealth they had. And the worst part? Sarah told me later that when they were buying, they knew the payment was tight. They knew they were stretching. But everyone around them kept saying, "You can always refinance, rates will come down, you'll be fine." And they believed it. Okay, third thing, and this is the one people skip all the time. You need to have a real emergency fund left over after you buy, and you need to have your consumer debt under control. Here's why. Houses break. I'm not talking about maybe they break. I'm saying they definitely break. It's not a question of if. It's a question of when. The water heater will die. The roof will start leaking. The furnace will stop working in the middle of winter. The dishwasher, the fridge, the air conditioning, something will go wrong. And when it does, it's not a $50 fix. It's $3,000, $5,000, $8,000, sometimes more. Most people buy a house and they drain their savings to come up with the down payment. They scrape together every dollar they have, they maybe borrow a little from family, and they barely have enough to close. Then they move in, they furnish the place, they buy a lawnmower and some tools, and within a month or two, they're back to living paycheck to paycheck with no cushion. And that's when life happens. That's when the transmission goes out on your car. That's when you need a root canal. That's when the basement floods and your insurance deductible is $2,500. And because you don't have any savings, you have no choice but to put it on a credit card. Now you're a homeowner, which is supposed to be this stable, wealth-building thing, but you're also in debt. High interest debt. The kind of debt that grows faster than your home equity ever will. So here's the rule. Before you buy a house, you need to have at least 3 to 6 months of expenses saved in an emergency fund. Not 3 to 6 months of your old rent. 3 to 6 months of your new house payment plus all your other bills, and that money needs to still be there after you've paid your down payment and your closing costs. If you're putting 20% down and that wipes out your savings, you're not ready. If you're putting 5% down and you only have $2,000 left in your account after closing, you're not ready. You need a cushion. You need margin. Because life doesn't care that you just bought a house. Life is still going to throw emergencies at you. And here's the other part. If you have credit card debt, if you have a car loan with a high interest rate, if you have personal loans or medical debt, you need to handle that first. Because here's the truth. If you're paying 18% or 22% interest on a credit card, that debt is actively stealing from your future. It's growing faster than your house will ever appreciate. So even if you buy the house and it goes up in value, you're still losing money because the debt is eating you alive. And here's the thing nobody wants to say out loud. You know why most people don't have an emergency fund when they buy a house? It's not because they're bad with money. It's because they can't afford the house. Think about that. If you're draining every dollar you have just to come up with a down payment, just to cover closing costs, just to move in, that's the market telling you something. It's telling you the house is too expensive for where you are right now. But instead of listening to that signal, instead of saying, okay, maybe I need to wait another year or two and save more, people just push forward anyway because they're afraid. They're afraid prices will go up. They're afraid rates will get worse. They're afraid they'll be stuck renting forever. So they ignore the math, they ignore the risk, and they buy anyway. And that's how people end up house poor. That's how people end up as homeowners who can't actually afford to live in the home they own.